So learning objective 3 talks about basically the what happens at the end of a useful life of a plant asset. Remember, when you buy a plant asset year, the business is going to use it for a period of time. That's its useful life. What happens when it comes time to dispose of that at the end of its useful life or somewhere in between? Well, there's really just a few choices that happen. So one is they could actually sell the asset to another party. That does happen. In a lot of cases, if the equipment is well used and there's no market for it, it's simply scrapped. That's considered retirement. Except you're not going to Florida on that one. And sometimes equipment is exchanged for new equipment. Okay. So in terms of when we talk about a disposal of plant assets, there's a few ways in which we're going to happen here that you need to be familiar with. Also, we have to know what happens on the record. You know, what happens on the books of the company when a plant asset is either sold off or retired. Okay. So on the date of that decision, of that disposal, we have to do a couple of things. We first have to credit the asset account for the value of the equipment. We also have to debit the accumulated depreciation for the accumulated depreciation on that particular equipment. But then we're going to be recognizing the difference between the book value, what we show it on the book value of the asset, with the proceeds. The proceeds are what we're getting for it. So let's go back to the last chapter where I think it was Bill's Pizza. They had a truck that they depreciated over 5 years, and its salvage value was $1,000. So the book value at the end of 5 years is $1,000. That would be the book value of the asset, right? So let's say they went ahead and I was able to sell that because, John really likes trucks. So this is a very small pizza truck. He always wanted to buy it from me. I'm like, okay, fine. You can buy my truck. John pays $1,200 for the truck. My truck has a book value of $1,000. Well, in this case, I'm getting $200 more, right, than the book value of the truck. So what do I have to do is I have to record that I have a gain of $200 on the disposal of that asset. This gain shows up on the income statement. If you go back to chapter 5 in your memory, you remember the multi-step income statement where there was that section, other revenue and gains, right? Other expenses and losses. Well, this would be an other gain. So this would be reported as a gain on that income statement for that year. What if John did once, like, I wouldn't give you $1 for this. Matter of fact, I would give you $1. I would just give you $1 for your truck. That's it. If you want me to buy it, it's $1. And I said, okay, I'll sell it to you for $1. Well, I just got $1 for this truck, but the truck is on the books. My book value is $1,000. So in this case, the proceeds are much less than the book value. So the difference I'm going to record as a loss on the disposal. So I'm going to have a $999 loss on the disposal of that truck. This loss also goes on the income statement in that other category, other expenses and losses. This would be another loss. So this is what you need to understand when it comes to a disposal of a plant asset. You're going to look at the book value of that asset, which, as you remember, is the cost minus accumulated depreciation. That's the book value. And you're going to compare it with whatever proceeds you get from selling it. Sometimes you're not selling it. Sometimes you're just simply scrapping it. So they won't be zero. Sometimes proceeds are zero. So just sort of understand you're comparing those two, and you have to report it on your income statement as either a gain or a loss. So you need to know how to calculate that. That's relatively straightforward, I think. Let's take a look at a sample here where this company has some office furniture. They have $60,000 of office furniture, but it has $49,000 of accumulated depreciation. So the book value for this office furniture is $11,000. That's the book value, right? Cost minus accumulated depreciation, book value. That's what they're going to compare to any proceeds they sell. So in this case, if they sell all that office furniture, say for $16,000, well, that's $5,000 more than its book value. So they're going to have to report a $5,000 gain on the disposal of that asset. Okay. So in the case of a gain, they're going to reverse out the equipment and the accumulated depreciation of equipment. And then they're going to show that they sold it for cash. And because they sold it for $5,000 more than its book value, that $5,000 becomes a gain. Okay. So that's just how it works. What if they only sold it for $9,000? Well, again, the book value of the furniture is $11,000. If they sold it for $9,000, they sold it $2,000 below their book value, so they would have to take a loss on that. And that's basically what you have to deal with here in Objective 3. The do it exercise for 3 goes over that. Here's a trucking company. They have a truck that costs $30,000. It has accumulated depreciation of $16,000. Assume 2 different situations, right? The first situation is the company sells the truck for $17,000. Well, again, you have to know, right, the cost minus the accumulated depreciation is going to be the book value. What's the book value of the truck? Well, it's the $30,000 minus the $16,000. So this truck has a book value of $14,000. You just got $17,000 for a $14,000 truck. You have to report a $3,000 gain. I'm sorry for my spelling here. But you'll have to report a $3,000 gain because you got $3,000 more than the book value. So that's reported as the gain. What if your truck is deemed worthless and you simply get 0 for it? Well, again, 0 would be considered the proceeds. You still have a $14,000 truck on the books. You got 0 for it. So you're going to have to report the difference as a loss that year. So the loss would be the full $14,000. Okay. So that's basically what you need to know about Objective 3 in a nutshell. Objective 4 is very important because of the type of assets we're talking about. Intangible assets, remember there are 4 classifications of assets. Intangible assets are that last classification. Intangible assets are critically important today. A lot of the biggest businesses that you know basically are in business because of their intangible assets. So Apple, Google, Microsoft, even if you look at Disney or others, I mean, these are basically companies that they've built their entire business around their intangible assets. Okay. So what are intangible assets? Well, it's certainly the proof of ownership of certain rights, privileges, or competitive advantages. The ownership piece is really the real important thing. Because if you can prove that you own an invention, if you can prove you can own that you own music, if you prove that you own artwork, if you can prove that you own a symbol or a jingle, then you can defend it in court, okay, against people that try to steal that. So the ownership is really, really important in this regard. So what are we talking about for ownership? Well, let's start at the top here. Like I said, patents are proof of ownership of an invention. So like I said, Apple, it runs basically, their entire company is based on their patents. Why? Because they are the proof of ownership that they are the inventor of the iPhone. They are the inventor of the MacBook. They are the inventor of these types of things. So that means that once this patent is recognized by the government, it proves ownership of that invention, which gives them the exclusive right to produce it. No one else can produce an iPhone except Apple. Okay. No one else can produce a MacBook except Apple. So that's the power of a patent, is it proves ownership. If another company tried to make an iPhone and Apple did not authorize that, then that's a lawsuit because you're stealing property. You're stealing property. The property is proven through the ownership, and patents are the ownership proof that you need. Okay. So in that sense, that's really really important to know.
Can't you make something and if you don't patent it, someone else can get the patent on it and then you lose all rights, or you didn't even have rights to it in the first place?
Yeah, I mean it's about proof of ownership. You can say you've invented something, but without the proof of ownership, people. I mean, you have to prove it in court that you're the owner. So if you've never gone through the process of creating that ownership through a patent process and application, um, then you can't prove ownership. And so yes, it's vulnerable to other types of things like what you were saying. We know patents are important to, say, the drug companies because they're creating, whether it's vaccines or various medicines, those are inventions. And so those patents are granted to those drug companies. And um, in that sense, they own it. No one else can produce it. So that's something to think about as well. The next intangible asset that's really, really important is something called a copyright. And again, the copyright is also proof of ownership, but for something that's a little bit more, let's either written or artistic in form. So we're talking about things like books, articles, right? We're talking about music. You can own music, both the lyrics and the sounds, the beats, etc. You can own cartoon characters. So Disney has a whole bunch of copyrights because every one of their characters is owned by Disney. They have a copyright on it. Um, you can have a copyright on code. So any type of software, whether it's Microsoft packaging it and selling it, a piece of software like Windows or Word or Excel, that's a copyright on that. Google, YouTube tend to run on those types of things as well. So they have copyrights on their code to some degree. Copyrights are very important because again, they prove ownership, and thus you can prove a loss in court. The reason you want to have these ownership things is because you want to be able to prove, in case it's stolen, that not only was your idea stolen, but the profits for that idea was stolen, and thus that's why the ownership is so important, because the court can correct a loss. A court cannot correct a rumor. You have to prove a loss, and ownership proves a loss. Okay. Another type of very, very important intangible asset are franchises or licenses. So a franchise is a contractual agreement um, to run a part of the business. But it doesn't mean that you're the owner of that particular business. So let me go with a large example of franchises down to a smaller one. Um, there's a lot of you that watch professional sports, whether it's the NFL, NHL, Major League Baseball, National Basketball Association, etc. Just for you to know, even though Steve Cohen bought the Mets, he's not the owner of the Mets. Okay. Major League Baseball owns all the baseball teams. What Steve Cohen has is a franchise. He's been granted a franchise, a right to run and own the Mets. But again, that had to be approved by Major League Baseball. Why? Because Major League Baseball owns it. Owns it. The NFL owns all the teams. Right. The National Hockey League owns all the teams. The fact that someone can buy a hockey team, that's an approval process. Why? Because it's a franchise. It's a franchise. So just sort of know that these are very big ideas. On the local level, you're very familiar with franchises. You've probably been to a franchise throughout your lifetime, whether that's filling up your car at a gas station. Most gas stations are franchises. You might have stayed at a hotel like a Marriott or a Hilton or a Days Inn, those are franchises. You have probably ate at a Subway or a McDonald's or Wendy's or whatnot. Most of those are franchises. Franchises are a very, very important part of how some companies do business. It gives them the legal right to run. It's a contract, though. It's a contract. You have to be approved to get a franchise. That's not like you're starting your own business. You don't need anybody's approval to start your own business, but you do need approval to purchase a franchise because you're buying into someone else's business. They own it. You're just getting the rights to run it. But as part of those rights, there's a contract that has to be followed. And that was one of the biggest problems with the Golden Corral that tried to open in Poughkeepsie on Route 9. The first person who had the franchise didn't follow the contract. So because that person, for whatever reason, thought he owned it. No, Golden Corral owns it. He's just the franchisee. So when you break a contract, the franchisor has a right to pull it out. And that's what they did with the first owner. He wasn't following the contract. Golden Corral yanked the franchise because they own it. They can do it. They found a second owner. That was the first time it closed. They found a second owner for the franchise. And then, of course, COVID hit. So bad luck for that particular restaurant. But franchises are very, very important. Okay. Trademarks and trade names, very similar types of things. So a trademark, would be any type of symbol that is owned by a company. So McDonald's they have a trademark on the golden arches. You see those golden arches, it's a symbol, yes, but it's a trademark. In other words, McDonald's owns it. No one else can use those golden arches. Dunkin' Donuts owns their symbols, whether it's the full name Dunkin' Donuts in that kind of orangey and other patent that they have, or the coffee cup with the DD on it and a little steam coming out. They own that. It's a trademark of that. Going back to professional sports, they own all the team logos. Those are all trademarks owned by the particular sport, whatever it's. So if it's a Yankee uniform, the New York Yankee, that symbol is owned by, it's trademark of Major League Baseball. So it's a very important symbol of ownership, because once you know you own it, you can sell it. The only way any company gets to sell, say, professional sporting goods is because they have gotten permission to use the trademark on their shirts, on their hats, on their coats, whatever they make. So that's really important to know. Okay. And again, Coca-Cola has a trademark. Even your local Stop and Shop, Price Chopper, ShopRite, all of those things are registered trademarks. They own, like Stop and Shop owns that little, it looks like a big fruit thing, a big watermelon with other little watermelons coming out. They own that. It's a trademark. So very important. Apple owns the apple with a little bite out of it. That's a trademark owned by Apple. You can't use that. Okay. Trade names are just as important, and so trade names are wide and varied. Trade names could be things like a Coke, right? I mean, if you walk into a store and you say, "I'll have a Coke," even though they have Pepsi, or they might have another cola. the trade name Coke is synonymous with that type of a drink. So when people walk in, I'll have a Coke, regardless whether it's Coke, Pepsi, or another beverage, they still use the word Coke because it's a trade name that's very popular. Same thing with Band-Aid. When you get a boo-boo or you get a cut, you need a Band-Aid. Band-Aid is a trade name for a specific type of bandage that's owned by a specific company. But, Band-Aid is a trade name. We often use it to identify a bandage, even though it might not be a Band-Aid brand bandage. Same thing with a Kleenex. You need to blow your nose or whatnot. You grab it. You go, oh, can I have a Kleenex? Well, it's a tissue. Kleenex is a specific trade name. But it's for a tissue in essence. But we've kind of all call it Kleenex. So these are important trade names. When you look at it from an entertainment perspective, it's even more important. You have trade names like Lady Gaga, for example. I mean, that's her trade name. She owns it. You can't use it. And whether that's there's other very famous people, whether it's Billy Joel, who's been around for 40 years, or Elton John for 40, 50 years. Those are trade names. They use that as their identity in the entertainment industry. So they have a trade name on that. You can't use it, even if you have the same name. Say, my name is Billy Joel. And I decided to open up a store and call it Billy Joel's. I may get a lawsuit that I'm infringing on the famous. They don't know me, Billy Joel, as this schmuck in Wappingers. They know the Billy Joel famous from Long Island, who's a singer, has been a singer for 50 years. I can't use his fame for my personal gain, even though I share the same name. I have to make my own name. So that's how important these things are from a business perspective. I know it might sound a little strange for some folks, but from a business perspective, you cannot gain on someone else's fame. You have to make your own fame. Goodwill is also a very important intangible asset to understand and know. The best way to describe goodwill would be when, let's say, I have a barber shop and I'm a famous barber in Poughkeepsie. I've been cutting hair for many years, and I have a grand reputation. Everybody wants to come to my barber shop. I have great staff. I have a great location. I have a client base that's very, a mile long. And I'm selling my business to Greg. Gregory looks at my balance sheet, sees that I have $100,000 worth of assets to buy for this business. Greg offers me $200,000 for my business. Well, why would Greg want to pay $200,000 for my business when he's buying only $100,000 of assets? Well, because the assets that he's also buying are not on the balance sheet, like my reputation, the reputation of the business, the client list, the fact that he's buying a business that already has a huge client base. He's also taking over the business, so he's going to be inheriting all my employees, which are well known as an excellent, staff that cuts hair very, very well. There are certain things that are not on the balance sheet that you're buying. That's goodwill. So when you're overpaying for something, it seems like you're overpaying for it. You're simply the extra money is goodwill. Let me go into another example that a lot of you probably know. First, let me just explain that Disney has all those Disney characters, whether you're looking at Mickey Mouse, Winnie the Pooh, or some of the more recent ones. They're all copyrighted, so they're owned by Disney. No one else can make or copy any of their products or characters without their permission, and that permission usually is in the form of a fee. And so, basically speaking, they own all of that. Disney had a problem maybe 15 years ago. They were really great at keeping younger kids entertained. But when kids started getting about 10 years old, particularly boys, they would be switching over to Cartoon Network, Nickelodeon, other places because they had fun characters that they could identify with. Disney could not come up with any characters that matched that demographic, so they were losing the preteens and the teenagers to Cartoon Network, to Nickelodeon, and others. So they decided to buy Marvel Comics. So they bought all of the Marvel characters are now Disney. Now, Marvel already was a very pricey company. They already had a lot of very good assets. Disney overpaid for Marvel, okay, in the billions. The extra billions were put on Disney's balance sheet as goodwill. Okay. A couple of years after they bought Marvel, Disney went ahead and bought all the Star Wars. They bought Lucasfilms. They bought all the Star Wars characters. So Disney has like a ton of characters now. But again, they overpaid for Star Wars as well. The extra billions they paid for Star Wars would be considered goodwill. Now, for all intangible assets, when businesses have them, they have to think about a couple of things. One, how long is this going to be useful for them? Some assets have what we call a limited life, mostly in the form of patents. Patents would have a little life. So if you have an invention of something great, it's very unlikely that invention is going to be great forever. It's going to be great until the next new invention kicks its ass, right? That's usually how it works. So right now, my invention is the talk of the town, but then a few years down the road, there's going to be something else that basically puts me out of business because it's a better invention. So in the case of certain inventions, they have a limited life. They have a limited life. And so, in other words, the business is only going to be able to capitalize on it for a limited period of time, after which there might be something much better that takes its place, and it's not going to be the basis of a business. So, for example, why would Apple want to renew its patent on its original iPod, right? Little music thing that you carry in your pocket. Why would they want to do that? No one does that anymore. It's built into your phone. Plus, you have all the apps now. I mean, it's a different world than it was when you have to carry around a separate iPod from everything else. Like you had a separate GPS, like you had a separate everything. Your phone, your iPod, your GPS, all these were separate items. Now they're all part of a phone. So it doesn't make any sense to renew a patent because it had a limited life. No one's going to buy a small iPod anymore. It doesn't make any sense to people today. So that invention, in essence, had a limited life. Right? It's incorporated into the phone now. However, there are certain things that have what we call an indefinite life. This is where copyrights come in, franchises, trademarks, trade names. They can have an indefinite life. In other words, there's really no end in sight to them. Mickey Mouse is it's about 100 years old, over 100 years. He's a very old mouse, okay? Winnie the Pooh, another Disney classic, was back in the 60s. That's well over, Winnie is an old Pooh, you could say. These characters they have an indefinite life. Who's to say no one's going to love a Mickey Mouse doll for their kids 100 years from now? How can you say that? So these things have indefinite lives. No one expects the NBA or the NHL or Major League Baseball to go out of business anytime soon. All those are indefinite lives. Would be playing baseball, or even on the moon someday, perhaps, right? A lot of home runs. So, basically speaking, these are indefinite lives. So that's important to sort of know. If it's a limited life, meaning the business can only use it for so many years, it's subject to a process called amortization, which is like depreciation. So you just learned about depreciation of fixed assets, right, that have a useful life. Well, if an intangible asset has a limited life, it's subject to amortization. So there's an amortization expense for intangible assets that have a limited life. However, if it's an unlimited life, which a lot of intangible assets fall under, there's no limit, and so there's no amortization. You can't really write that off. Okay, so that's really important. A couple of just different points here that I wanted to make out. and give you an idea from a business perspective. Patents are good for 20 years. And a patent is an exclusive right to make something and sell something and control it. This is what's going on. This is one of the reasons why we have in this country the highest prices for pharmaceutical products in the world. When a drug company creates a certain medicine, they get a patent on it. That patent is good for 20 years. They're the only ones who can manufacture and sell it. Now, some other companies are working on their own medicines. So whether it's to cure cancer or other types of things, or to take viruses out of our system or neutralize them, they're all working on something. But in the case of a company that gets a patent and a drug that's approved, that really means a lot to people, whether that's for diabetes, kidney disease, other types of things that are very widespread. That company basically has a monopoly in the drug because they're the only ones who can manufacture and sell it. And when you're the sole seller of a product, you can charge as much as you want. I mean, how much is a life worth? A lot. And so they know that they charge a high amount of money. So this is one of the reasons why we have the highest prices for medicines on the planet, is because it's these patents are good for 20 years. A lot of people say, well, I can just get a generic. Well, no, you can't. In other words, in order for anything to become a generic drug, the patent has to expire. So these patents are good for 20 years. After 20 years, they expire. When a patent expires, anybody can make the drug, which is why anybody can make aspirin, anybody can make Tylenol, anybody can make Advil, anybody can make Motrin. Those patents have expired a long time ago. Anybody can make it. When anybody can make it, you get a lot of supply, prices go down. You can go into the dollar store, get a bottle of aspirin for $1. So why? Because anybody can make it. Okay. So that's the difference between when you have a patent on a drug and they're the only maker of that drug. They charge very, very high prices. But once that patent expires, those prices come, falling down to the earth. So that's really important to sort of understand about patents. One other thing about copyrights is a copyright is it lasts for the life of the creator plus 70 years after they're dead. Copyrights, it's a big business. It's a really, really big business. And I think you kind of need to know how important it is. You probably have heard this song in the past. Everybody get up. Woo! Yeah. Hey. Okay, so you probably have heard that Blurred Lines, Robin Thicke song from the past. Now, unfortunately for Robin Thicke and company, that beat was copywritten from a group in the 70s. And when they heard it, they knew that it was basically stolen because they didn't get permission to use the beat. You can get permission from groups to redo their songs. That happens all the time. In this case, they didn't do that. They didn't honor the copyright. So the group from the 70s sued and won. Because why? Because they were able to prove through the copyright they were the owners. And they went, hey, woo, all the way to the bank. Because, Robin Thicke had to give up quite a bit. It was a very profitable song for them. But just to know, that's the power of copyright. Another thing to know too is even though artists have, some artists have been dead for a while, they're still making money. Their estate's making money. Prince is still making money. Michael Jackson's still making money. Kurt Cobain, he's making money, Nirvana. So everyone who's passed, particularly in the last 20, 30, 40 years, they've done this copyright thing right. They're still making money up to 70 years after they're dead. Now, of course, they're dead. They're not making the money. Their estate is making money. So the money is simply being distributed through their estate to their heirs. So it's very important that you understand how important this is for business. For business. Okay. So all the fourth learning objective is understanding what these concepts are and how to identify them. Okay. There's no accounting that you have to know per se. You just have to know what each of these things are. Makes it fascinating and interesting. Okay, the last learning objective here in the chapter looks at property, plant, and equipment and intangible assets, how they're reported on the balance sheet. And we're going to do a little bit of analysis. Okay. So first, take a look at, we have a Coca-Cola partial balance sheet showing their property, plant, and equipment and their intangible assets here as well. So again, just to know that property, plant, and equipment, the list here should also reflect the list here. So land is property, buildings are plant, machinery is equipment. So it sort of fits in. Notice they subtract out their accumulated depreciation as well. Intangible assets don't have as much of a pecking order. Coca-Cola has a lot of trademarks, clearly. One of the things they do have, they have franchises. Everyone who bottles Coke is basically a franchise. So those rights have to be paid for. They collect a certain fee from all those bottling rights, etc. So very, very important to understand the power of franchise rights. Two pieces of analysis that are pretty quick and easy to understand. First one is are your assets generating a profit? Okay, so we look at the net income compared to the total assets, and we call that return on assets. So here's the formula here. Net income is the profit. Average total assets, beginning and ending total assets averaged together. And that gives us something called a return on assets. Are your assets making a profit? So here, JetBlue 2014 numbers, they had $550 million profit for that year. Average total assets of about $7.5 billion, roughly. That's a 6.8% return on assets. That's excellent. That's really, really good. That means for every dollar in total assets, it produced roughly almost a 7-cent profit. That's good. That's really, really good. Of course, clearly much better than their prior year. 2013 was much lower for JetBlue. Southwest Airlines, they are also doing quite well. They had a return on assets of 5.7%. So for every dollar in average total assets, it's returning about a 6-cent profit for them. That's really awesome as well. Good, very good numbers for both these airlines. Compared to all airlines in 2014, the industry is all airlines, their return on assets was 4%. So here you had Southwest Airlines flying at a much higher altitude there, right? And JetBlue was well over 30,000 feet. They are flying real high there. The other financial ratio you have to know is something called an asset turnover, which basically are your assets generating sales. Because why else do you have all those assets? Why would you have all those buildings and equipment? You want to sell stuff. So asset turnover basically has us compare the net sales over the average total assets. That's the same number you saw in the previous ratio. So for JetBlue in 2014, they had sales of 5.8 billion over average total assets of around 7.5 billion. So that's 0.77 times asset turnover. Another way to look at this too, if you wanted to interpret it this way, is roughly for every dollar of total assets, they generate about 77 cents in sales. Okay, so that's pretty good. Clearly better than their previous year, which was 0.75. So the higher, the better. But look at Southwest Airlines. Woo, man, they've just increased their altitude. Their asset turnover is exceptional. 0.94 times is exceptionally good. They are using their assets extremely efficiently because they are selling lots and lots of stuff. Okay, 0.94 times is great. The industry, nothing to sneeze at, 0.8 times. Again, pretty good. Don't have to worry about profit margin because we talked about it already in chapter 5. So do an exercise on 5 here. Learning objective 5 is all about asset turnover. Here we have Paramore. They had net income, so they had a profit of 180. Net sales of 420. Total assets of 460 in January. December was 540. So you're going to take the average. These two numbers averaged together will give you your average total assets. For asset turnover, we need our net sales over our average total assets. So net sales is 420, average total assets, you average out those two numbers, comes to 500,000. So here we have an asset turnover ratio of 0.84. So roughly for this company, they're generating about 84 cents in sales for every dollar of total assets. And that, my friends, is the rest of chapter 5. But I think the intangible asset piece is always a topical issue for a lot of people because it's so important today. Any questions?